time. Harsha Upadhyaya is a market master today. He's President and Chief Investment Officer, Equity at Kotak Mahindra Asset Management Company. Harsha, good morning. Good to have you with us here. Thank you very much for your time. Actually, let's just start with the auto ancillary space and the numbers I'm sure you've seen what CEAT has reported. Your thoughts on it's a space which has been kind of a dark horse, has done very, very well. Not just the OEMs, but maybe OEMs more than auto ancillaries this year. Ancillaries did very well over the last 2 years. What's your view? I mean, tires as a space and, the sector as a whole.
Good morning, Prashant. Clearly, auto sector seems to be doing quite well in terms of the volumes. Whether you look at any of the subsegments there, all of the subsegments seem to be growing at a reasonable pace. So clearly, for auto ancillaries, this is a big boost as they get much of their volume from OEMs. And even the replacement market in many of the auto ancillaries have picked up. So overall, I think the growth trajectory for auto ancillaries seem to be quite strong. And we have also seen margins improving as commodity costs have moderated. Although we should keep in mind that crude has moved up, and at some point of time in the near future, there could be some pressure on overall margins. But nevertheless, all auto ancillary segments seem to be doing quite well. And in particular, tires also seem to be seeing the benefit of lower raw material costs at this point of time and better margins. As we move ahead from a medium-term perspective, we still continue to be very positive. We do have a couple of positions in the tire segment in our portfolios. However, in the very near term, there could be some lag impact of higher crude oil prices.
Okay, Harsha, hi, good morning. By the way, the tire space is the one that's really on fire this morning. Not just CEAT on the back of numbers, but there's buying in JK Tires up almost about 8%. Apollo Tires, MRF, all doing pretty well. And I think it was expected that these numbers would be good given the lower raw material costs. But the additional positive impact of a better product mix where they sold higher number of two-wheeler tires and that helped them is something that has, given a fresh set of wings to a lot of the other tire makers as well. Bajaj Finance and Bajaj Finserv, the twins are also doing very well, topping the charts as we speak. Expectations perhaps that the numbers would be good this time. And there's additional news on Bajaj Finance as well. Harsha, hi, good morning. How are you feeling about the markets in general? What is the stand now? Do you put more money to work? If yes, what are the big themes that you're looking at?
Sonia, clearly the undertone in the market seems to be quite positive. While valuations are higher than average or fair range of valuations, I would say that the overall sentiment seems still positive. But we need to keep in mind that from here on, the stock performance would be dependent more on earnings deliveries. I think most of the near-term positives have already been discounted. So I think earnings delivery is going to be crucial for stocks to sustain these valuations or to move higher from these levels.
Hi, Harsha. Good morning. Do you think there's a scope of disappointment? At one point in time, the street was very comfortable. Mid-teens growth, the nifty EPS is very gettable. Now we could have some supply disruptions that are coming back, given the conflict that's picked up in Israel. It could have repercussions for the rest of the globe as well. Do you think that mid-teens earnings growth is at risk?
I would say that as of now, there don't seem to be too many risks. Yes, we need to keep an eye on what's going to happen on the crude oil pricing side. Yes, as long as the conflict is very, very localized, then you may not have a big impact on the crude oil prices. But if any of the other countries from the Middle East join the war, then I think there is going to be a bigger issue. And that's where I think crude can move up much higher from current levels. So it's something that we need to remember. And at the same time, we have also seen about a 30% increase in crude oil prices in the last 3 months or so, right? From a low of almost $70 to a barrel, we are at about $90 to a barrel now. So already there has been an increase in crude oil prices, which will flow into margins in terms of adverse impact over the next 1 or 2 quarters with a lag. So there is going to be some impact on the margins anyways that is expected. However, at this point of time, at least for the large cap basket, we don't see too much of earnings risk. Over the next 2 years, we are expecting about 16-17% earnings CAGR, and I think that should happen. And even in the worst case, if there is some disappointment, I think there is not much of a valuation discomfort that is there in that basket. However, if you look at mid and small caps, for example, the earnings CAGR is about 25% for the next 2 years. And also the valuations are at a premium to large cap, as well as the historical mid and small cap average valuations. So to that extent, if at all there is a risk in terms of earnings delivery, that is going to be larger in mid and small caps. So to that extent, we remain slightly cautious on mid and small caps as compared to large caps.
Harsha, on financials, we've seen numbers from HDFC Bank, but I mean, slightly top-down view, and there could be outliers here. The view which seems to be developing is that the best maybe is behind on growth, on asset quality. Margins maybe, it's a different story and it will depend on what happened on interest rates. But what's your sense, Harsha?
Prashant, the best may be over in terms of net interest margins, but I don't think the best is over in terms of either the growth or asset quality trends. I think we are at a nascent stage of a new cycle in terms of lending. So to that extent, very unlikely that from a system perspective, there will be too many asset quality issues to contend with. Similarly, the growth seems to be quite strong, both on the retail segment, and also we expect overall corporate lending should also pick up over the next quarters further from these levels. So overall, I think the situation is quite good for banking and financial services. However, as we have already discussed many a times in our interactions earlier, there seems to be some pressure on the net interest margin. So to that extent, yes, when you look at financial year 24 earnings growth for banks in particular, as compared to the previous year, there is a slowdown, but it is still a healthy earnings growth, which is higher than the overall market average. So to that extent, this is not a segment that will probably underperform for a long period of time. Maybe it will not perform as much as what we have seen in financial year 23. That's possible, and that's already visible in terms of the stock performance of the sector. Nevertheless, I think it's not a segment where you can avoid. You need to have a position, and from a medium-term perspective, this is likely to continue outperform.
Okay, by the way, JK Tyres is now up 9% and has hit a fresh 52-week high. That's JK Tyres for you. So the street is definitely building in a lot of positives ahead of these earnings. After seeing CEAT's fabulous performance, JK Tyres has now risen almost 85% in 2023. So that's the move there. But Harsha, you said you're bullish on the tyre segment and the auto sector also is doing well. But where do you see the valuation growth even now in the OEMs? Is it in names like Maruti, M&M? Do you like the commercial vehicle makers like Ashok Leyland? If you can just split it up for us segment-wise.
If you look at the near-term growth trajectory, I think except for tractors, everywhere there seems to be a reasonably strong volume growth trend. And we have also seen a lot of new models coming and hitting the market. So to that extent, I think the excitement still continues on two-wheelers, passenger vehicles, and also commercial vehicles seem to be doing reasonably okay. So all these segments are expected to show a better volume as we go ahead, and margin should also improve. So overall, auto is one basket where you will see significantly higher earnings growth as compared to the market expectation of about mid-teens growth for Nifty. So to that extent, I think while some of these positives have already been discounted in the stock prices, but we do believe that there is more to come, and this should continue to outperform the overall market over the next couple of years.
All right. What about the state elections up ahead? Do you think that's a risk in the near term? Because that could go either which direction. Though for 2024, the street is definitely factoring in that the current government, the BJP-ruled government, does continue with their policies and also all that they've already started.
Nigel, it's always very difficult to predict election outcomes. I mean, we struggle to predict where the markets are going to go, and elections are even more difficult in that sense to predict. All I would say is if the valuations are at reasonable levels, when you enter the election phase, then probably the downside volatility will be less, even if there is a disappointment compared to market expectations. But if you enter the election phase with all the positives already having been discounted and valuations at a very, very high level, then even if there is no disappointment, there could be some profit after that. So this is how we would probably see. We don't really take event-based bets in our portfolios, but depending on the overall valuations, we will see whether there needs to be a defensive tilt to our portfolio or not. As far as the current valuations are concerned, we are comfortable with large cap valuations. And as I mentioned earlier as well, a mid and small cap segment is where we have slight nervousness. And it all depends on where we end up before entering the elections on these segments. And depending on those valuations at that point of time, we will probably take a further view.
Okay, Harsha, we'll leave it there. Thank you very much for your time. Great speaking with you. And it's always a pleasure having you here on CNBC TV18. So that's the view coming in from Kotak Asset Management Company. The market is up just under